Joining us from New York is Parets, founder of allstarcharts.com, and joins us now. Well, let's get right to it, JC. You always bring something interesting. Well, the first chart we're going to look at is GDX. I think you've drawn the line in. Some people would call this a breakout from a pretty nasty downtrend. Tell us what this chart's telling you.
Sure, it certainly looks like it, doesn't it, Francis? I mean, you know, how many times have you and I done this? How many failed breakdowns have we pointed out in the past that have just turned into, you know, rip your face off rallies, right? You know, you and I joke about it, but, you know, it's really true, and these are really powerful, you know, sort of implications from these scenarios. So as the chart shows, you know, last year in the second half of the year, we broke down below those 2008 and 2009 lows. I mean, gold miners have just been absolutely destroyed. I mean, it's not a secret. And sentiment got to a bearish level, a bearish extreme that we've never seen before. And, you know, slowly but surely at the beginning of the year, prices were able to creep back up above those 2008, 2009 lows. So what happens is it leaves all of those short sellers caught down there. You know, anybody who was long against those 08, 09 lows is no longer in the trade if they got stopped out. That unwind of those positions, you know, creates very powerful rallies, and this has the potential to double from here, Francis. I got to tell you, and more importantly, most importantly, in my opinion, is that the risk is so well defined. Francis, we broke out above that downtrend line from the last couple of years. We broke back above the 08, 09 lows, and that's your line in the sand. If we're above both of those, we could be as aggressively long as we want. And if we're not above those levels, we don't want to be in this trade. So I love that the risk is very well defined, and the upside certainly justifies that risk.
Now, we're looking at, this is the GDX, so that's the miners. That's where all the torque, my favorite word for 2016, is when it comes to a rebound. What's bullion look like, just by the way?
Well, you know, listen, I think that what happened in January in precious metals is something that we can't take lightly. When you see those sort of explosive moves, and I'm not sure if you guys have the chart up, but, you know, really in the last couple of months of the year and going into January, silver and gold were both consolidating in very traditional continuation patterns. Obviously, the underlying trend in both of those had been to the downside. And, you know, when you have traditional bearish continuation patterns resolved to the upside in a bullish nature, the market is speaking. And, you know, the market is telling us that there are larger forces at work, and that's really what got us bullish last month. And I think the fact that that follow-through, that explosive thrust higher, that torque, if you will, I don't think it could be taken lightly. I think we're going a lot higher in all of them. But obviously, you're going to get the best bang for your buck in the gold miners for sure.
Let's talk about oil, because the question is the bounce that we've seen a head fake, or is it something more long-lasting? We've got a graph that you're looking at. This is oil and relative strength.
Yeah, you know, I think that it's a similar situation to the gold miners. You know, last year in the second half of the year, we broke below the 2008, 2009 lows, very similar to gold miners. Eerily similar. We're still below those levels, but I got to tell you, if we start creeping back above that 33 and change level, which were the lows back then, I think we could see a monster squeeze. I think oil could see 50 bucks, and similar to gold miners, that line in the sand is very clean and very well drawn. So again, in oil, you know, if we're above those 08, 09 lows, the risk is very well defined, and we could be in it. And if we're not above those levels, we don't want to be in it. So it's really that simple.
I love how you put it. Sometimes it just seems that simple. I wish I could keep reminding myself of that. Let's look at the broader market, the S&P 500. Looks like another W that we've had here. We had the W in August, and it looks like another W to me with my limited technical analysis capabilities. What does this tell you? We're looking at it right now with some lines drawn in by you.
Sure, Francis, you got to give yourself a little more credit. I think you're absolutely right. That sort of double bottom sort of thing. We're not just seeing that in the S&P 500. We're seeing it in the Russell 2000, the micro caps, the mid caps. So we're really seeing it across the board. We're seeing it globally around the world in a lot of international markets. With the new lows in February, we saw bullish momentum divergences at those new lows. Yeah, I think this bounce has legs. I think we could see 2,000 in the S&P 500, maybe even more. I'm still bearish, bigger picture. I think ultimately we roll over, in the second quarter. I wish I had a crystal ball and I could tell you exactly what day. But, I think structurally things are still a problem. But short term, I think that the breadth has improved. In the new lows that we made in the S&P and the Nasdaq a couple of weeks ago, there were fewer new 52-week lows on the New York Stock Exchange, about half the amount that we saw in January. So we are seeing that breadth improvement, not just domestically, but globally, especially globally. And I think the S&Ps have moved to the upside. But I just want to reiterate that I think that the U.S. and other developed markets continue to underperform. Most of the global markets around the world, particularly emerging markets and those with energy, metal, mining exposure, they all bottomed in January. Chile, South Africa, Peru, all of those countries all bottomed in January, and I think they continue to outperform the U.S. That's really where the trade's at, not in the S&Ps.
This might be a sort of something new. You've also looked at two companies for us. One, they've been terribly beaten up. One's Yahoo, the other's Twitter.
Yeah, we made new lows in both of those in January and then rolled over again and this month. And then when you see that roll over to new lows and that quick recovery, that's your entry point, Francis. I mean, you follow my stuff. You've been reading my stuff for years. The line in the sand was very well defined. Yahoo obviously exploded. Our upside target, it's almost hit. But in terms of Twitter, I think we still have upside. And on both of those, again, reiterating that line in the sand, it's those January lows. As long as we're above those January lows, we can be long. If we're below that, we don't. So, I think that the main premise of all of the things we discussed today, Yahoo, Twitter, oil, gold, is that the lines in the sand are very well defined. The market doesn't always make it that clean on us, as you and I have both learned the hard way over the years. But sometimes it does, and I think this is one of those situations.
JC, great to see you in New York. We'll talk to you again soon. Thanks for taking the time today.